Is the housing market in the United States in a bubble and headed for a crash? Let's take a look and see what is going on with the housing market. This is Bitcoin right here. I'm not talking about Bitcoin at the moment. Housing market. Okay, so the housing market, this is a new survey that was just done by Zillow and their research department. You can go to Zillow, scroll down to the bottom of the page and hit research. Lots of great information about the housing market, articles, things like that. But there was a survey done by economists, government analysts, and the private sector, where 60% of the survey experts do not believe that the US housing market is in a bubble. So 60% of the experts polled said they were not in a bubble, compared to 30% who do. The panel experts see a short recession by 2024 as the Federal Reserve works to tame inflation. The panel raised home price growth forecasts for 2022 as demand stays strong. So these experts consisted of, like I said, government analysts, economists, and then the private sector. So my guess is the 60% that said we're not in a bubble were probably people that are with the government and are economists and not in the private sector, because, or, just like transitory inflation, people in these government positions and these economists that operate on theory and academia and do not have to make a profit or out in the real business world generally are kind of, not really looking at the writing on the wall. I mean, when you hear the Treasury Secretary say that, I was wrong on inflation, and the Federal Reserve say that transitory inflation and that we don't have, issues in the housing market, things like that, it's just not grounded in reality of what's going on out there. So here's how the 60% that do not believe that the housing market is in a bubble. They say there's no bubble rationale. They're saying that the recent price growth, 32.5%, the recent price growth can be explained by fundamentals such as demographics, shifted housing preferences, and scarce inventory. But this was all driven, the demand and the demographics and all that, it's all driven by low interest rate. Credit risks remain low due to sound underwriting and mostly fixed rate, fully amortized mortgages. Ease of borrowing money. It was pretty easy. Interest rates were really low, which were created by the Fed, created by economists and academics, not people out in the real world having to generate a profit and keep things at good, consistent levels for profitability. But this is true. The mortgage market is much, much healthier than it was in like 2008, 2009 timeframe, or even times in the past. The term bubble implies a subsequent crash, and there is not likely to be one soon. So just like transitory inflation, or inflation is transitory, there's no real inflation, and now the narrative is that inflation has peaked. We have the inflation report coming out on Friday, so we'll see where that's at. I don't think anybody watching this has seen any prices come down or peak. It just seems to keep going up in everything that we consume every day. So whatever they're measuring is the same people that are measuring this kind of stuff, right? So it's really interesting. And I'm not saying that, housing is going to crash everywhere all over the country, but prices are already starting to adjust. We're already seeing inventory levels climb. We'll take a look at that in a minute. We're seeing transactions down big time. We're seeing mortgage applications down. So the market is starting to correct. And what really defines a crash? 30%, reduction in values. You will see that in certain markets as interest rates continue to climb, and especially if they get into 6%. We haven't seen a crash yet because rates are still in the fives. As I've said all along, 5% in the upper fives will create a correction, and it'll create it quick, which it did, much faster than I even thought. Rates jumped up quicker than I thought they would. If you see rates get into the sixes, then you're in crash territory for housing. In terms of, demand destruction, because the affordability index for people borrowing money, then it just really gets out of reach for a lot of borrowers. And, prices have to correct. And the first place it shows up, as I've been talking about, is in new construction, resort markets, and then the resale market. As inventory starts to stack up, people have choices. You'll see more and more price reductions. And we're already seeing price reductions up 20 to 30% or more all across the country in different markets. But then there's other markets where, it's still red hot. There's still a lot of competition, and stuff still sells for more than asking. So it's very, very hyper local. But the most popular respondents rebuffed the bubble thesis because of strong market fundamentals, including demographics, scarce inventory, shifting housing preferences, Low credit risk as a justification followed due to sound underwriting and the overwhelming share of fixed rate, fully amortized mortgages. So very healthy mortgage market. So I don't think we're going to see a foreclosure crisis like we saw in 0809, but you're definitely going to see, with higher interest rates as they continue to go up, demand destruction and more price reductions, and prices becoming more reasonable and back to normal levels in terms of appreciation. These same experts are saying, when it comes to when will the next recession hit, while the panel largely does not believe the housing market is in a bubble, it does foresee a recession coming soon. Although the large portion of the panel, 45%, expect the next U.S. recession to begin in 2023. We're already in a recession. We already had our first quarter of negative GDP. It wasn't much. Second quarter is probably going to be negative as well. You're seeing earnings miss and guidance being reduced for a lot of companies. So recession's already started. I don't know what means they're using to measure recession, but it's just basically negative GDP for 2 consecutive quarters or more. You can see what the forecasts look like in terms of, when most experts believe that, the recession will begin, Q1, Q2, 3, 4, all, through the different years, what percentage of those respondents, said when that recession will begin. But they polled more than 100 experts from academia, government, and the private sector. So my guess is the 60 and the 40s on these conservative ends are probably coming from academia and government and not the private sector. So can the Fed thread the needle? That's a big question right there. The Federal Reserve is working to strike a balance between twin mandates of reducing rampant inflation and avoiding the recession. We've been talking about that, and the likelihood of the Fed landing the recessionary plane, the inflationary plane smoothly is slim to none. Trading Economics is a great little resource, has a lot of really good data on the housing market. So we're looking at inventory levels here. And as you can see, since January of this year, inventory has been rising each month. As rates have ticked up, inventory levels are ticking up. But when you look at the last 5 years, we're still nowhere near where inventories were 5 years ago, even 10 years ago, going back to 2014. If you go over a 25-year period, here's 2008 and 9, some of the highest inventory levels. The peak of the housing market ran up in that 2004, 5, and 6 timeframe. We peaked 06, 07, 08. Those were the highest inventory levels, lots of new construction coming online in the pipeline, big, giant subdivisions of thousands of homes, complete and totally vacant because we were just building like crazy. Then we had the crash, and inventory levels have been kind of working their way down, kind of steady, from 2011 through 2000, really 17, 18, when the market started ticking up until the Fed tried QT the last time and tried raising rates. Housing market tanked for a while. I mean, literally overnight, kind of shut off, and then inventory levels, have been dropping ever since. And of course, the pandemic really put a dent in inventory levels. So really interesting data to look at there. And then here's something that's really interesting here as well. And this was part of the big issue in 2009 that created the huge recession, borderline depression area, because housing creates so many jobs. This is really interesting. This comes from the National Association of Realtors. How do home sales affect the economy and the job market in your state? You can kind of drill down and see the total economic impact of a resale home, an existing home sale, is about $113,200 in the economy between income generated from the real estate industries, ancillary types of businesses, expenditures directly related to the home purchase, the multiplier of housing related expenditures, new home construction, and then of course, all of the money that trickles through the economy due to a home sale and a new construction home through all of the different suppliers, vendors, subcontractors, and everything throughout the process. So really interesting stuff. So the real question is housing in a bubble? Is there a crash coming? So a crash would be defined as probably 30, 40, 50% drop in prices. We're already seeing some markets heading in that direction, and some houses, because they're way overpriced to begin with, are dropping price that much to get it sold if they have to get it sold. So when you're talking about these things and what they're really looking at, and the reason the information and data looks a little skewed is because they're talking about averages in general. So national averages, things like that. And real estate's hyper local. Every market's different. Every city is different. Every neighborhood is different. Every street, every block, every lot and, house on that lot. Everything's different when it comes to real estate. So to try to look at averages is very difficult from a national standpoint. Like, the median price of a home is probably rising while interest rates go up and inventory levels rise and transactions go down, because they're looking at a mean, or median average, in the middle, right? So as the bottom drops out or the top drops out, that mean average changes, or median average changes quite a bit, right? So mean is an average, median's in the middle. So you really can't look at national averages. You got to look at your market. And one of the best ways to do it is just go on Zillow, type in your neighborhood and start tracking houses. You can set up an alert. You can watch price action. You can watch price reductions. You can watch properties that were under contract that are coming back on the market. And then you can also track new construction in your area, just to kind of keep an eye on what the home builders are doing, how inventory is stacking up there, how traffic is down. Go visit some open houses and see what's going on out there. And you'll see, how the market is changing in real time because of interest rates, because they were so artificially low for so long. Now they've jumped rapidly and they're hanging in the fives. If interest rates get in the sixes, then it'll probably, that will generate crash, bubble crash territory, as if interest rates get to that 6% level. So those are the things I'm looking at for the housing market. I'll see you in the next video.